If the market dropped 67% tomorrow, how many of your investments would actually survive? Because when we ran the numbers on the last 3 major crashes, only 5 types of assets consistently made it through. In every major crash, one brutal pattern repeats. Most investors spend years building a portfolio, and then, in a matter of months, 40, 50, even 67% of it can disappear. It happened in 2000, when the dot-com bubble burst. It happened again in 2008, when credit markets froze. And it happened in 2020, when a global shutdown exposed just how fragile the system really is. But here is what almost nobody looks at. Not which stocks did well, but which types of assets quietly survived across multiple crashes over decades of data. Because behind the headlines, big institutions and billionaires are not just diversified. They concentrate into a small set of assets that historically hold their value when everything else is getting liquidated. So in this video, we are going to strip out the hype and look at the numbers. We backtested the major drawdowns of the last 30 years to see which assets actually protected capital when markets were in freefall. And when we finished the analysis, only 5 stood out. Most investors operate under a dangerous assumption that diversification alone provides protection. The classic 60-40 portfolio, split between stocks and bonds, is supposed to be the bedrock of stability. But during systemic crises, that correlation breaks down in the worst possible way. Assets that were supposed to move independently suddenly move together, straight down. Look at 2008. When Lehman Brothers collapsed, it was not just stocks that plummeted. Corporate bonds froze. Real estate markets seized. Even municipal bonds, traditionally seen as safe, faced liquidity crunches. The diversification failed because the crisis attacked the entire financial system's plumbing. Liquidity evaporated. Everyone was selling what they could, not what they wanted to. The 2000 dot-com crash provides another case study. A portfolio heavy in technology stocks was obviously devastated. But what about a diversified one? The contagion spread. Companies cut spending, which hurt industrial stocks. The economic uncertainty hit consumer discretionary names. The only thing that worked was a flight to safety. But most retail portfolios were not positioned for it. Then came 2020. This was perhaps the clearest example. For a brief, terrifying period, even US Treasury bonds sold off. Everything was liquidated. This is the moment when modern portfolio theory shows its greatest weakness. It assumes markets are rational and liquid. A systemic crisis proves they are neither. The institutional secret is not more diversification. It is smarter concentration. They understand that during a panic, you do not want to own a little bit of everything. You want to own the specific assets that become the lifeboats. The ones everyone rushes toward when fear overwhelms greed. This is not about picking winning stocks. It is about identifying structural, safe harbors. Asset 1. Treasury bonds are the cornerstone of crisis investing. When fear spikes, capital does not just move, it flees. And its primary destination is the perceived safety of the United States government's balance sheet. This is not a subtle trend, it is a tidal wave. During the 2008 financial crisis, while the S&P 500 fell nearly 50%, long-term Treasury bonds gained over 25%. Why? Because when confidence in corporations and banks evaporates, confidence in the full faith and credit of the United States intensifies. The United States government can print money to meet its obligations. A corporation cannot. This creates a fundamental safety premium. The mechanism is straightforward. In a crisis, investors sell risky assets and use the cash to buy treasuries. This massive inflow of demand pushes bond prices up and yields down. So you get capital appreciation on top of the safety. It is a double benefit: preservation of capital and positive returns when everything else is negative. The 2020 COVID crash presented a fascinating test. For about a week, even Treasuries sold off. This was a liquidity event, a dash for cash. But it was short-lived. The Federal Reserve immediately stepped in, announcing unlimited quantitative easing. They became the buyer of last resort. This is the critical backstop. The Fed's mandate includes stabilizing financial markets, and its primary tool is supporting the Treasury market. That backstop is what makes this asset uniquely resilient. The strategy involves understanding duration. Long-term bonds are more volatile, but offer greater potential appreciation during a crisis. Short-term bonds are more stable, but offer less upside. Institutions typically ladder their holdings, and they always maintain a significant core position in treasuries. It is the ultimate panic room for capital. In the current yield environment, this asset class actually provides a meaningful income stream, unlike the near-zero rates after 2008. This adds another layer of protection. You are not just betting on price appreciation, you are getting paid to wait. When the next crisis hits, the flight to safety will happen again. The data from the last 3 decades shows it is one of the most reliable moves in finance. Asset 2. Gold, the ancient store of value. The second asset operates entirely outside the traditional financial system. Gold represents a lack of confidence in the system itself, while treasury bonds represent confidence in a specific government. Gold is the ultimate non-correlated asset, and its performance during crises explains why it has been a store of value for millennia. During the dot-com crash from 2000 to 2002, as the Nasdaq collapsed by over 75%, gold began a major bull market. It was not a coincidence. Investors were fleeing paper assets, especially technology stocks that had no earnings, and moving into something tangible. Gold gained over 40% during that period, providing a stark contrast to the devastation in equity markets. The 2008 crisis is even more telling. In the immediate panic following Lehman's collapse, gold did something counterintuitive. It initially sold off. This is a critical point that most people miss. In a true liquidity crunch, everything gets sold to raise cash. That sell-off was brief. Once the initial panic subsided and the scale of the monetary response became clear, gold embarked on a historic run. It was the anticipation of massive money printing by central banks that drove its value. Investors understood that the bailouts would debase currencies, and gold is the classic hedge against that. By 2020, the pattern was well established. When the COVID lockdowns hit, gold again saw a short, sharp liquidation. But its recovery was swift and powerful. It quickly reached new all-time highs as the Federal Reserve balance sheet exploded. This is the core dynamic. Gold reacts to the monetary response to a crisis, not necessarily the crisis itself. It is a bet on the long-term consequences of stabilization efforts. There is an important distinction between physical gold and paper gold. Exchange-traded funds, like GLD, are convenient, but they represent a financial claim. In a true systemic failure, the value of that claim could be questioned. This is why institutions and central banks themselves hold physical bullion. It is an asset with no counterparty risk. You do not need to trust a bank or a government to honor its value. For over a decade, central banks globally have been net buyers of gold. They are diversifying away from the US dollar. This is not a speculative trade. It is a strategic repositioning by the most sophisticated players in the system. They see gold as a fundamental anchor for their reserves, especially in an era of high debt and geopolitical uncertainty. As an inflation hedge, gold's record is mixed over short periods, but over the long term, particularly during periods of monetary instability, it preserves purchasing power. In a crash scenario, the immediate concern is capital preservation. The secondary concern is what happens after the crash. The stimulus and debt monetization that follow create inflationary pressures. Gold protects against that second phase risk, making it a unique asset that serves two purposes: a safe haven during the storm and a guard against the aftermath. Asset 3. Defensive equities, cash flow stability. The third asset might seem contradictory: equities. But not all stocks are created equal, especially in a downturn. While the broader market collapses, a specific subset of companies tends to hold up remarkably well. These are defensive equities, businesses that provide essential goods and services, the ones people cannot stop buying even in a recession. The consumer staples sector is the classic example. Companies that sell food, beverages, and household products exhibit incredibly stable cash flows. During the 2008 crisis, while the S&P 500 fell nearly 50%, the consumer staples sector fell less than 30%. That outperformance of over 20 percentage points is a massive cushion for a portfolio. People still need to eat and drink, regardless of the economic cycle. Utilities are another resilient sector. Demand for electricity and gas is non-negotiable. These companies are often highly regulated, which limits their upside in good times, but also provides a floor in bad times. Their revenues are predictable, and they typically pay substantial dividends. During the 2020 crash, utilities held up significantly better than the broader market. Their low volatility and high dividend yield act as a magnet for capital-seeking stability. The healthcare sector, particularly pharmaceuticals and medical devices, also demonstrates defensive characteristics. Healthcare spending is largely non-discretionary. While elective procedures might be postponed, essential treatments continue. The sector's performance during crises is less about soaring and more about not collapsing. It provides a stable anchor in an equity portfolio that is otherwise getting hammered. This resilience is not accidental. It is quantifiable. Factor investing identifies the minimum volatility factor and the quality factor as characteristics that tend to outperform during market downturns. Minimum volatility stocks are simply those with historically lower price swings. Quality stocks are companies with strong balance sheets, stable earnings, and high profit margins. These factors are embedded within defensive sectors. When you buy a consumer staples ETF, you are effectively loading up on these defensive factors. The dividend component is crucial. In a zero-interest rate environment, a stable dividend yield becomes a powerful source of total return. Even if the stock price stagnates or falls slightly, the dividend provides a positive return. This is a key differentiator from growth stocks, which derive their value from future expectations that get crushed in a recession. Comparing 2008 to 2020 shows a consistent pattern. In both crises, defensive sectors significantly outperformed cyclical sectors like technology, industrials, and consumer discretionary. The lesson is that within the equity universe, there are pockets of safety. Diversification within equities is not about owning every sector. It is about owning the right sectors for the right part of the cycle. For crisis preparation, that means a deliberate overweight to businesses whose revenues are immune to economic contraction. This is how institutions use equities not for aggressive growth, but for stable cash flow and capital preservation when it matters most. Asset 4. Managed futures, trend following. The fourth asset is perhaps the least understood: managed futures. These are funds that systematically follow trends across commodities, currencies, and bonds. Their value in a crash comes from their ability to go short, profiting from downward moves when traditional portfolios are suffering. This is known as crisis alpha. During the 2008 crisis, while the S&P 500 fell nearly 50%, Many managed futures strategies produced significant positive returns. They captured the relentless downtrend in equities and other risk assets. The mechanism is purely systematic, removing emotion from the equation. When a market trend is established, these funds ride it. The 2020 flash crash was another perfect example. The extreme volatility created powerful short-term trends that these strategies were designed to capture. They provide liquidity to panicking markets, effectively getting paid for being on the other side of the trade. Unlike traditional hedge funds, their returns come from market structure, not stock picking. Asset 5. The contrarian play, what institutions hide. The fifth asset is the true contrarian play, the one that institutions accumulate quietly. It is volatility itself, specifically through instruments like VIX-related products. When fear spikes, volatility explodes. While this crushes most portfolios, it creates massive gains for those positioned correctly. The structural reason is simple. Volatility is a direct measure of market fear. In a systemic crisis, the VIX can spike from 15 to 80, a move of over 400%. Institutions use complex options strategies to capture this, but the principle is accessible. It is the ultimate hedge, behaving inversely to the market when it matters most. The implementation is challenging due to decay, which is why it is a tactical, not long-term holding. But for crash protection, its non-correlation is nearly perfect. It is the insurance policy that pays out exactly when your other assets are failing. So how do you combine these 5? It is not about equal weighting. It is about creating a portfolio with non-correlated return streams, a core of treasuries and gold for stability, defensive equities for income, a smaller allocation to managed futures and volatility for true crisis insurance. The goal is to have something that works when the traditional playbook fails. The pattern is clear across multiple crises. Most portfolios are structurally vulnerable because they rely on correlations that break under stress. These 5 assets offer proven, non-correlated protection. If you want to understand the implementation details for each, subscribe for our deep dive on building a resilient portfolio. Next, we will show you how to spot the signals that precede a major downturn.